Charge going up, fire in the hole, go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to cover one of the most important topics in all of trading, risk management. Risk management is what separates professionals from gamblers. It's how you stay in the game long enough to build consistency, protect your capital, and let your edge play out over time. There are three main tools you'll use to manage risk in every trade: the stop loss, the take profit, and the trailing stop. Let's start with the stop loss. A stop loss is a protective order that automatically closes your position when price moves against you by a set amount. It's the line in the sand that says, if I'm wrong, I'm out. For example, if you buy NQ at 15,500, you might place a stop loss at 15,480. That's a 20-point stop, or $400 of risk per contract. If price falls to that level, your broker closes the trade automatically. The purpose of a stop loss isn't to be perfect, it's to protect your account. Every professional trader uses one, every single time. Hoping the market turns around is not a strategy. Next is the take profit, or target order. This order automatically closes your trade once your goal is reached. Using the same example, if your target is 15,540, you're aiming for 40 points of profit. That's $800 per contract. Notice the math here. You're risking $400 to make $800. That's a 1-to-2 risk to reward ratio, which means even if you're right only half the time, you'll still be profitable over the long term. That's how professionals think. They plan the risk and reward before entering the trade. The third tool is the trailing stop. A trailing stop follows price as it moves in your favor, locking in profit while still allowing for more upside. For instance, if you are long YM at 38,000 and price moves to 38,050, your trailing stop might automatically shift from 37,980 up to 38,030. If the market suddenly reverses, you exit with profit instead of giving it all back. Trailing stops are excellent for trending markets when you want to let a winner run without manually adjusting orders. Now let's talk about position sizing, because even the best stop loss won't save you if you're trading too large. The rule is simple: never risk more than 1-2% of your total account on a single trade. If you have a $5,000 account, risking 2% means your maximum loss should be $100 per trade. Work backward from there. Divide your dollar risk by the tick value to figure out your stop size and number of contracts. This ensures that no single trade can wipe you out. Remember, trading is a game of probabilities. You're going to take losses. That's part of the business. Risk management ensures that no single loss is large enough to matter. When you control risk, you control your emotions. When your emotions are under control, your decision making becomes sharp and objective. That's what professional trading looks like. So before you enter any trade, ask yourself three questions. Where is my stop loss? Where is my take profit? How much am I risking in dollars? If you can't answer all three, don't take the trade. In the next lesson, we'll go deeper into how your account value changes as trades open and close. We'll explain the difference between balance, equity, and margin calls, and how to keep your account healthy and safe from forced liquidation.